The S&P 500 is officially positive on the year. Back in April, things were looking quite shaky when the S&P 500 was down more than 15%. However, we just saw the second fastest recovery in modern history. So we're essentially back to square one, and there's still not a lot of clarity on some things to make us move to the next leg higher. There's still a lot of uncertainty around tariffs. There's uncertainty around earnings growth and the impact tariffs are going to have, and that brings back the equation of valuation concerns. But does that mean we stop investing altogether? No, because you often hear me say, I prefer time in the market over trying to time the market. And there's still plenty of stocks that look intriguing from a valuation perspective. And that's exactly what we're going to talk about today. We are going to dive into 5 of the best stocks to consider buying for your portfolio in the month of June. So make sure you stay tuned throughout the entirety of today's video. But before we do jump in, do me a huge favor, simply show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 5 of the best stocks to consider buying for your portfolio in the month of June. Beginning with stock number 1, which is going to be MRVL Technology, stock ticker MRVL. Now, MRVL just recently reported their Q1 earnings, which were actually pretty good. They beat on both the top and bottom line. However, the stock fell more than 5% in the day after the report. Is it time to buy, or is there further downside ahead? I believe this is a quality name at a quality price. Right now, shares of MRVL have a market cap of $55 billion. Over the past 12 months, shares are down 16%. Year to date, though, down 42%, and down more than 50% from its 52-week highs. So it's been tough sledding for those that do own MRVL. Not a position that I am in yet, but one I'm deeply looking into buying in the month of June. As I mentioned recently, the company reported their Q1 earnings in which they beat on both the top and bottom lines. Revenues came in at $1.9 billion, 64% higher than the year prior. EPS came in at 62 cents per share. Analysts were looking for 61. And then Q2 revenues looking forward are expected to increase to $2 billion, which is higher than the $1.9 billion analysts were expecting. So what are investors concerned about, which led them to primarily hit the sell button, and the stock fell more than 5%. A lot of these concerns center around the slowdown from 2 major hyperscalers, which happen to be customers of MRVL, those being Amazon and Microsoft, 2 companies working on their own custom chips. Amazon continues to make great headway in their own custom chips, but from what we've already heard from the likes of the CEO of Microsoft, they have been slowing down a bit on their CapEx spending. However, these are opportunities that I love to find in high-quality companies. It's not that something is broken with the company, it's a movement on when that revenue and those earnings are expected to come. They are being pushed out a few quarters, so I can deal with the near-term headwind and slowdown and a bit of volatility if it means long-term success. Let's take a look now at valuation, where analysts are looking for the company to generate next 12 months earnings of $2.80 per share, which equates to a forward PE multiple of 22.8 times, well below the company's 5-year average of 29.5 times, and earnings are expected to grow on average of over 50% over the next few years, giving them a PEG ratio well below 1 at 0.4. Analysts also very upbeat on the stock, rating it a strong buy with an average 12-month price target of $94 per share, implying more than 50% upside from current levels. And again, let's say that earnings do get pushed out a little bit so that the estimates from analysts are going to come down over the next 12 months. We are still looking at a valuation that looks rather cheap. Now let's move on to stock number 2, which happens to be my largest individual holding, that being Alphabet, stock ticker GOOGL. Alphabet is a name that's had a nice recovery, with the stock gaining more than 15% over the past 3 weeks as compared to the S&P 500 over that time, gaining 5%. The company currently has a market cap of $2.1 trillion, again making it one of the largest companies in the US. Over the past 12 months, though, shares are down 2%, and year-to-date, still down 10%. So as you can see there, even after the surge that we've seen over the past 3 weeks, shares of Alphabet are still down on the year, and they are still the best valuation of all the Mag 7 companies. But Alphabet is getting a lot of momentum outside of their search business. When you look at things like robotaxis, in which they are a clear-cut leader, even with all of the talk of Tesla coming into the equation, Waymo, far in advance. Then you look at what they're doing with AI and how that is going into search as well. There's a lot of momentum even outside of search. The company recently held an AI-related conference in which they said Gemini 2.5 now has more than 400 million monthly active users, and all of this AI is being rolled into search. A lot of the sell-off that Alphabet has seen in 2025 has been related to potential forward weakness in search. However, with AI capabilities, it seems like it's only strengthening it. Taking a look at valuation, analysts are looking for the company to generate next 12 months earnings of $9.59 per share, which equates to a PE ratio of less than 18 times, well below the company's 5-year average of 22.2 times. They have a multi-year average growth rate of 14%, giving the shares a PEG ratio of 1.2. I like to see things below 1.5. Analysts rate the stock a strong buy with an average 12-month price target of $198, implying upside of roughly 16%. And that leads us to stock number 3, which is going to be Energy Transfer, stock ticker ET. So those first two companies that we talked about are more centered around growth. These next few we're going to take a peek at are centered around dividends. And Energy Transfer, if you are a dividend investor seeking a higher yield, this might be just the stock for you. The company currently has a market cap of $61 billion. Over the past 12 months, up 14%, but year-to-date, down 11%. For those of you unfamiliar with Energy Transfer, the business is a midstream energy company engaged in the transportation and storage of natural gas and crude oil. Right now, the price of crude sitting in the low $60 range is weighing on the business, but natural gas is what I'm focused on. Natural gas prices have rebounded in a big way, from below $2 to now trading close to $3.50, up 33% over the past year. Seasonality is also quite strong in both June and July, for that matter, for shares of ET over the past decade. And even with all of that, you also get a juicy dividend yield. That yield currently sits at 7.4%. However, given that the yield is so high, it's not usually a company that grows their dividend all that much, as you could see with the 5-year dividend growth rate. Now turning our attention to valuation, where analysts are looking for the next 12 months earnings of $1.41 per share, which equates to a forward PE multiple of 12.5 times and an EV to EBITDA of just 8.7 times. Analysts currently rate the stock a strong buy with an average 12-month price target of $23 per share, implying upside of 31%. And again, that's just upside from a share price appreciation. You also need to add in that dividend yield. And that leads us to stock number 4, which is going to be Johnson & Johnson, stock ticker J&J. And when it comes to Johnson & Johnson, they continue to have this cloud over their head as it relates to the lawsuit centered around talc. Now that's hopefully something that we're expected to get some sort of clarity on in the near future, and that's going to be huge for investors. But outside of that, this is a business that's still performing quite well, even given the size. The company currently has a market cap of $370 billion. Over the past 12 months, up 6%, and year-to-date shares of J&J are up 7%, easily outpacing the S&P 500. Zooming in on the chart for the past 3 years, we could see that the stock has been trading in a downward trend, making lower lows and lower highs. But something changed recently, in which the stock briefly broke that trend and has been consolidating around the $150 level. Could this be the turnaround we've been waiting for? Well, in the company's latest earnings report, we saw them beat on both the top and bottom lines, ensuring that the business is still fully intact and still growing. The company also increased its forward guidance. And on top of that, this is a company that pays a safe, reliable, and growing dividend, growing to the fact that they are a dividend king, meaning that they have grown their dividend for at least 50 consecutive years. And in the case of J&J, they've done it for more than 60 consecutive years. That dividend currently has a yield of 3.4% and a 5-year dividend growth rate of 5.4%. Taking a look now at valuation, where analysts are expecting the company to generate $10.61 in earnings this year, giving them a forward PE of 14.5 times, below the company's 5-year average of 15.8 times. In fact, that's not the only thing that looks intriguing. EV to EBITDA trades at just 11.5 times, the lowest in more than a decade for shares of J&J. Analysts rate the stock a moderate buy, with an average 12-month price target of $170 per share, implying upside of roughly 10%. And that leads us to our final best stock to buy in the month of June, which is going to be NextEra Energy, stock ticker NEE. This is a company that I recently put on another video, but I continue to believe in the valuation right now, and I don't want you to miss out on this opportunity. It's also a name that I picked up and added to my portfolio back on May 22nd, when I put a buy alert in showing all of my Edge Plus subscribers, saying I was adding to my position, and that happened to be the low point for the stock. Since then, shares have rallied roughly 10% in a little over a week's time. These are the types of things that we're constantly trying to bring to our members to give them an edge and make them aware of what's going on in the market. So become an Edge Plus subscriber today, where you can get access to my entire portfolio, get buy alerts, stock deep dives, join our monthly members only meeting, and join a community of over 20,000 members. Check out the link down in the description below. But now getting back to NextEra, and there's a number of reasons that I like this company. I believe they have great share price appreciation growth potential. They have a solid dividend yield and strong dividend growth. These are the types of companies I refer to as investors' trifectas. The company currently has a market cap of $142 billion. Over the past 12 months, shares are up 8%, and year to date, they are down 4%. After the House passed the so-called Big Beautiful Tax Bill, shares of clean energy companies were tumbling. You look at Sunrun was down more than 40%. NextEra fell 10%. But not all clean energy companies are created equal. But why were all of these companies falling so hard? It's due in part that this bill is expected to repeal all of the clean energy tax credits. However, given the fact that I'm well versed and been following NextEra for a number of years, I know that they are leaning heavily into the likes of solar and wind, primarily solar, but that's not the majority of their business. They are already a well-defined utility company, which is where most of their earnings come from. So yes, will the investment on clean energy slow down if in fact that bill were to pass? Absolutely. But that leads me to reason number 2. Do you believe that that bill is going to pass as is? Right now, stuck in the Senate, it doesn't appear so. So if we do get any relief on some of those clean energy tax credits, it would send the stock soaring. Now, before jumping into valuation, let's take a look at the dividend, where you currently get a dividend yield of 3.3%, 5-year dividend growth rate of 10.4%, and nearly 30 consecutive years of dividend growth, firmly making shares of NEE a dividend aristocrat. Now turning our attention to valuation, where analysts are looking for next 12 months earnings of $3.67 per share, which equates to a forward PE multiple of 18.8 times, well below the company's 5-year average of 24.2 times. Looking at EV to EBITDA, shares trade at 17.8, also well below the company's 5-year average of 19.4. Analysts currently rate the stock a moderate buy, with an average 12-month price target of $83 per share, implying upside of 17% over the next 12 months. So there we just looked at 5 different stocks to consider buying for your portfolio. Stocks that come from a number of different sectors. Dividend stocks, growth stocks. Down in the comment section, you let me know which of these 5 stocks is your favorite on the list. And make sure you join our community over at the Stock Investor's Edge so that you can gain an edge in your investing as well. Thanks again for watching. And if you haven't done so, show your appreciation. I really appreciate it if you could simply click that like button down below and join our community here on YouTube by subscribing to the channel. Thanks again for watching, and we'll see you in the next one. Take care.